Following our analysis of Virgin Galactic Holdings, we turn our attention today to a quite different segment of the aerospace industry, Innovative Solutions and Support Inc., a micro-cap player in the aerospace and defense sector.
That's right. Innovative Solutions and Support, they specialize in flight navigation, display systems, and, other essential components for the aviation market. The company recently closed at $11.85. That gives it a pretty modest market capitalization of about $209 million and an enterprise value near $232 million.
And the central question we really need to grapple with today is this. Does Innovative Solutions and Support's truly exceptional operational efficiency and its, frankly, explosive headline earnings growth, does that position it as a dramatically discounted future prospect?
Or, conversely, do its, astonishingly high cash flow valuation metrics, coupled with the worrying pattern of significant insider selling, do these reveal a fundamental financial weakness, something the market might be overlooking or perhaps deliberately ignoring in its pursuit of growth? I'm going to argue that the structural financial concerns here present just too great a risk premium.
And I'll be arguing that the combination of, industry-leading margins and a strategic footprint expansion really confirms that this is a classic high-growth investment scenario, where the current price looks highly appealing relative to its projected trajectory. Okay, so the bull case for Innovative Solutions and Support, it really starts and arguably ends with performance. This isn't a company showing just, stagnant growth. It's a company that has nearly doubled its output year over year. If we look at the trailing 12 months, or TTM, earnings per share growth, it's exceeding 80%, and sales growth is over 72%. This pace of expansion is nearly unheard of, especially in the more mature aerospace and defense segment. But what truly cements the value case, I think, is how cheap this growth looks when we consider the future. The company's projected price earnings to growth, or PEG ratio, it's extremely low, just 0.47.
Now, given that the consensus projection for their 5-year earnings growth is pretty robust at nearly 38.4%, a PEG below 1.0 is probably the clearest signal you can get that the stock is currently undervalued relative to its growth potential. And this growth, it seems to be high-quality growth too. You just have to look at the profitability metrics. Their gross margin is strong at 45%, and the return on equity is over 23%. These numbers, while they tend to prove management is effectively translating sales into profit and is an excellent steward of invested capital. So when you see operational success confirmed by recent news things like securing a multi-million-dollar military products contract and the selection of their specialized autothrottle for the U.S. Army C-12 fleet, you are looking at what seems to be a fundamentally sound scaling operation.
I see why you'd cherry-pick those metrics. They are indeed flashy, but I would argue that those headline growth rates are potentially masking a critical, maybe even existential problem related to actual cash generation and investor confidence. While the PEG ratio offers, sure, a snapshot of future earnings potential, the valuation metrics tied to actual cash flow are, they're terrifying. We are looking at a price to free cash flow, or PFCF, of 237.37. Let's just pause on that number for a second. 237. If a PFCF of maybe 20 is considered high, paying 237 times for every dollar of actual cash the business generates, it suggests that investors are accepting an astronomical and, I would argue, likely unsustainable premium.
Furthermore, let's look at the financial structure that kind of underlies this problem. The balance sheet, yes, it shows a current ratio of 3.53, which looks fine on the surface. But this is immediately undermined by an extremely low cash reserve. The company has only, get this, 3 cents in cash per share. So this combination, astronomical cash flow valuation and minimal cash just sitting in the bank, it suggests that the company is effectively financing its explosive growth either on borrowed time or perhaps through some sort of working capital acrobatics. And finally, the insider behavior. To me, this provides a tangible vote of no confidence.
Insider transactions show a massive net reduction of over 23%. And this wasn't just, a small sell-off here and there. A key 10% owner, Christopher Harborn, liquidated millions in shares across June and July 2025 at pretty high prices too. When major stakeholders sell aggressively right after positive news hits the wires, it strongly suggests they believe the stock has peaked, doesn't it?
Okay, let's pivot directly to the heart of that disagreement then. The conflict between that incredible PEG ratio, 0.47, and the admittedly extreme PFCF figure of 237. I maintain that the PFCF, while jarring on its face, is likely a temporary, necessary artifact of the growth strategy itself. Think about it. When a company increases sales by over 70% in a single year, it must aggressively invest. This involves heavy capital expenditure, right? Building inventory to fulfill those new military contracts you mentioned, expanding working capital to support the strategic acquisitions of the Honeywell product lines made in 2024 and 2025. These are capital deployment phases, not cash harvesting phases. And if we look at the forward PE of 16.23, which is, quite reasonable for a company with 38% projected growth, the market seems to be implicitly agreeing with me. They are valuing the future earnings, trusting that the current high cash burn is merely the cost of scaling into a much larger, more profitable entity down the road. It feels like you're punishing the company for the exact mechanism required to achieve the growth we both agree is, phenomenal.
That is an interesting defense of the PFCF, classifying it as a necessary artifact. However, I would frame it differently. Exceptional sales growth that crucially fails to translate into proportionate free cash flow raises some pretty deep concerns about the quality of those earnings. If the PFCF is 237, it means the business might be using its sales revenue not just for investment, but potentially just to keep the lights on and manage working capital efficiently or inefficiently, perhaps. Even high-growth companies, they tend to normalize their PFCF much faster than this, especially in the aerospace sector, where contracts should theoretically be cash positive relatively quickly. So how long can the market be reasonably expected to treat heavy, continuous CapEx as just some temporary growth anomaly? If this temporary reinvestment cycle lasts another 2 or 3 years, the stock will essentially be relying solely on future sales growth to justify a multiple that is completely, utterly disconnected from current fundamental cash generation. That implies to me a systemic reliance on external capital or consistently delayed cash conversion cycles. And let's follow up on that idea of systemic reliability and turn to the issue of insider selling versus perceived financial strength. You referenced the strong liquidity ratios, the low debt-to-equity ratio of 0.41, which, yes, suggests low leverage. Fine. But that financial structure didn't stop Christopher Harborn, a 10% owner, from selling off a huge chunk of his position. Diversification, it doesn't really explain a 23% net reduction that conveniently coincides with periods of record revenue reports and strategic announcements like that new $100 million credit facility they secured in July 2025. The timing here suggests that the insider, who arguably has the clearest view of the internal financial pressures and the operational runway, it suggests he viewed the stock as having hit a cyclical peak right when the positive news hit the wire. That is a tangible multi-million-dollar vote of distrust, I'd say, in the sustainability of the current valuation.
I see why you feel that way, but let me offer perhaps a different perspective on insider behavior. Insider selling, it's easy to sensationalize, but we have to place it in context. While a 23% net reduction is substantial, yes, we also must look at where the institutional money is flowing. Institutional ownership remains quite robust at over 40%. And interestingly, institutional transactions actually show a net positive inflow of almost 6%. So, smart money seems to be actively increasing its position, sort of counteracting the individual selling. Furthermore, that balance sheet stability is precisely why the selling, even if it was motivated by a perceived price peak, doesn't necessarily indicate distress. The company secured that $100 million credit facility back in July 2025. That facility dramatically stabilizes the capital structure. It makes them ready to finance future acquisitions or buffer any short-term cash flow issues that are frankly inherent in scaling large military contracts.
The low leverage and the safety provided by those liquidity ratios mean that even if the PFCF is temporarily distorted, the company is structurally capable of meeting its obligations and executing its growth strategy without, fear of immediate insolvency. The company seems built to withstand this kind of operational volatility. And that operational execution really brings us back to the core momentum. The narrative you're building seems to focus entirely on temporary financial pressure, while perhaps ignoring the success of the underlying business strategy itself. The consistent flow of strong operational news, acquiring multiple Honeywell product lines across 2024 and 2025, that looks like strategic genius to me. This isn't random expansion. It's actively strengthening their competitive mode in mission-critical flight technology. And focusing on military applications, which is confirmed by the U.S. Army C-12 auto-throttle selection and recent multi-million-dollar contract wins, that ensures a stable, likely high-margin revenue stream going forward. These strategic moves are verifiable indicators of a business that's actively expanding its market reach and reinforcing its profitability profile. That's what's driving the record revenue highlights we saw in the Q1 and Q2 2025 earnings calls. This momentum is real, and I believe it justifies the bullish long-term valuation indicated by that low PEG ratio.
But have you considered the immediate and frankly devastating impact of recent results on market psychology? Strategy is only as good as its execution, right? And at the end of the day, market perception is what often matters for the stock price, at least in the shorter term. The stock was down a staggering 41.5% immediately following the Q3 2025 release back in September 2025. That level of extreme, sudden volatility, despite the seemingly positive strategic narrative, it tells us one thing very clearly. The market is highly sensitive to any shortfall in cash flow or earnings. It arguably confirms the fears that the operational momentum simply cannot consistently justify that hyperinflated PFCF valuation. That level of extreme, sudden volatility, despite the seemingly positive strategic narrative, it tells us one thing very clearly. High expectations linked to a rapid succession of acquisitions, which are inherently high-risk, high-reward ventures. They demand flawless execution. A 41.5% drop shows that even the slightest deviation from perfection results in massive shareholder punishment. That volatility suggests that the extreme PFCF isn't just some temporary anomaly, but perhaps rather a reflection of the deep execution risk that the market is currently struggling to adequately price in. The growth story is only compelling if you assume near perfection, and Q3 2025 showed that perfection is, elusive.
Like volatility is, a fact of life for microcap growth stocks, especially those in the aerospace and defense sector, which often rely on large, sort of lump sum government contracts. The Q3 drop might have been a reaction to short-term expectations, not necessarily a fundamental reversal of the trend. The strategy itself, I believe, is sound. They are growing revenue rapidly, they're generating industry-leading margins, and they're acquiring key product lines that solidify their market position. That low PEG ratio, again, it offers a buffer, maybe a margin of safety, against future volatility. It suggests the underlying earnings power is significantly undervalued. I believe the path to normalization is clear. The newly acquired Honeywell lines and the military contracts convert fully into predictable revenue streams. The cash flow will inevitably catch up, reducing that PFCF multiple over time and hopefully rewarding patient investors.
The extreme price to free cash flow isn't a temporary nuisance in my view. It's a structural financial vulnerability. It tells us that for all the explosive revenue growth you champion, the company is struggling profoundly to turn those sales into usable cash. Now, this vulnerability, combined with the clear, documented insider selling, a major shareholder deciding now is the time to cash out, it's just too much risk to ignore lightly. The core debate, I think, remains whether this explosive revenue growth can actually normalize into sustainable free cash flow generation quickly enough to prevent market volatility from forcing a disastrous and potentially permanent correction. The burden of proof really remains firmly on the company to demonstrate consistent cash generation, not just headline revenue growth.